Hi everyone. So recently, one of the US's foremost bank called as Silicon Valley Bank has unfortunately collapsed. The regulators have stepped in and now they are trying to figure out how to return the money back to their depositors. This has created a mass panic in the US stock market, so to say, and something like US Nifty Bank has collapsed by roughly 12% over the last 5 trading days. Even the international investor community is a little bit scared because a lot of startup money is stuck with this bank. For example, some of India's foremost names in the startup community like Paytm, like Shadi.com, even their money is stuck with Silicon Valley Bank. Gary Tan, who is the president of Y Combinator, which is one of the foremost names in the startup ecosystem community, he has called this crisis an extension level event. So is there a genuine reason to panic? And will this crisis spread to India as well and Indian stock markets also? And what led to the origination of this crisis? Even if you are a school going student, you will be able to absorb all the information that I am presenting to you, and you will learn a lot of macroeconomics and finance along the way. So do press the like button. I know that you haven't pressed it. Do press the like button and we will kickstart this video. So in order to understand the origination of the crisis, you need to quickly understand the operating model of Silicon Valley Bank. Now basically this is a bank for startups. They get VC funding. So VC funds are what? VC funds are these big players. For example, Gary Tan runs a company called as Y Combinator, and these are large investors who give their money to these early stage startups, and then these companies take on money and they grow. But many a times what these companies do is that, for example, Ola, let's say it's received a funding of 1000 crore, then some amount of this money they will consume immediately in terms of hiring, building operations, testing products, vagera, and a large part of it would be stuck or kept in a bank. Now, many of these startups, or rather 50% of these startups, which is in US tech and life science, used to give their money to Silicon Valley Bank. So just to cut the long story short, Silicon Valley Bank used to primarily cater to the startups. Now, any bank has two primary functions. One is that they take money from depositors like us. For example, if you consider the banking model of HDFC Bank, how does the bank make money? They will take our money. For example, I will go and deposit, let's say 5,000 rupees in HDFC Bank. Now, since I have given my money to HDFC Bank will give me a rate of interest on that loan at, let's say, 3% or 2% on savings account. Now, the bank will take that money and further loan it out to different parties in terms of giving business loans, in terms of giving housing loans, etc. And in the middle, they will make a certain spread. For example, these days, the housing loan rates are roughly 10%. And how much money am I getting on my deposits on savings account of HDFC Bank? I am primarily getting around, let's say, 3 or 4%. Now, 6% becomes the spread of HDFC Bank. Now, in SVB Bank's perspective, what was happening was that they did not have any deposit or bad loan problem per se. Now, what is the meaning of this? For example, many of these startups, Ola, Uber, etc., they were giving their money to Silicon Valley Bank. They did not have a deposit problem. But on the flip side, not too many organizations, and especially startups, were borrowing money. Why was this the case? For this to understand, you need to check the interest rates and at what scale they have been escalating. So right now in the US, the rate of interest is roughly 5%. That is the Fed rate. So the business loans could go all the way up to 7-8% also, which is fairly high in the US economy. So as a result, first and foremost, the Silicon Valley Bank was facing an operational problem. There was another problem that was brewing up, and it was the withdrawal problem. So again, going back to our model that I was earlier explaining. So all these startups, imagine that Ola has $100 million stuck with Silicon Valley Bank. Now, what is happening in the market is that because the interest rates are fairly high, so Ola might not be taking any new loan. That's one. Second, many of the new age startups that were planning their IPOs. For example, in India, we had Byju's, we had Mamaearth, and a bunch of other startups which are like unicorn level startups. They have also postponed their IPO plans. So again, they are not getting any new money. So what these startups started doing was that they thought that, hey, you know what, we have cash lying around, so we will go and withdraw this money from Silicon Valley Bank and use it to fund our operation in this interest rate environment where the cost of capital or the cost of borrowing is becoming very high. So Silicon Valley Bank was unable to give out new loans. Second, the rate of cash withdrawals accelerated and a lot of parties started asking for their money back. And third and finally, what accelerated this crisis was bad investments from Silicon Valley Bank's behalf. So for that, let me take you to the balance sheet of Silicon Valley Bank and explain this point by using some numbers, facts and figures. So this is the group's balance sheet, and what you would notice is that they have something called as held to maturity securities. And you would also notice that the total quantum of these securities is roughly $91 billion. Now, if you notice this particular sentence, it is fairly interesting that they have written fair value of $76 billion. So roughly there is a loss of $15 billion on this security. Now, this is a slightly technical finance concept. So let me take a minute to explain this, that what is the meaning of held till maturity securities. Now, basically held till maturity type of securities are a bond. Now, bond is simply a promise that is made between two parties. So basically when you do a fixed deposit, it is a type of a bond. For example, you are going and depositing 1 lakh rupee today in HDFC Bank, and it is saying that we are going to pay you 7.5% rate of interest on your fixed deposit if you do a fixed deposit of, let's say, 2 years. So that is a type of a contract between you and a bank. So HTM securities are also like that. Now, Silicon Valley Bank was getting a lot of deposits from its customers. So for example, let's assume that it got $150 billion of customers deposit. Now, what is it going to do with that? It typically would go and put it or try to put it in safe investment instruments like held till maturity securities. Now, the way these securities work, that they are bought at a discount and then they mature at the face value. For example, the bank will get to buy these securities at $98, and after 30 years, they might mature at $100 or $105 depending on whatever the contract says. Now, the type of maturities that Silicon Valley Bank procured was 30-year securities. Now, what it typically said was that, you know what, we are buying these securities at $98, and I'm just using it as an example. We will hold it for 30 years and then we are going to make $105 or $100 on it. So that is how this instrument was designed. Now, the held till maturity securities also have a functionality that in case the party who is holding these securities need to sell it and avail that money immediately, then they can go to the secondary market and sell it at whatever the existing price is. Now, the interesting bit is that whenever the interest rates in the economy rise, the price of the bonds decrease. So I hope that you understood this complicated concept as to why the value of these held till maturity security on the balance sheet was $91 billion. But as of today, its value was $76 billion, and the bank was having a notional loss of $15 billion. Now, if the bank's balance sheet is really strong, then absorbing this loss of $15 billion is not that big a deal. But if you go and analyze the balance sheet further, what you will notice is that the value of total equity comes out to be roughly $16 billion. Now, the loss that the bank is having is $15 billion, and total outstanding equity value is roughly $16 billion. Now, in the event of any other additional default, this bank is likely to collapse. So that is the specific reason why this bank collapsed like a house of cards and the regulators had to step in. So now comes the natural question that why the bank had to book a loss of $15 billion in terms of selling these securities. Because if they would have simply held on to these bonds and waited till maturity, they would have recovered this entire price, because that is how the bond functions. Well, the answer again there lies in the form of bank run that was happening, that the startups required money. A lot of startups were withdrawing the cash from them. Some startups looked at the balance sheet that I just showed you and figured out that, you know what, this bank is sitting on barood, so let us withdraw our cash quickly. Now, another panic was created by Peter Thiel, Gary Tan, and all the prominent VC investors who are highly respected in the startup ecosystem community. One of these investors advised their portfolio company that, hey, you know what, this bank is likely to go under, withdraw your money. And that just created massive panic, and the bank, in order to create that additional liquidity, had to sell these assets at a massive loss. So now comes the second most critical question that, okay, fine, Silicon Valley Bank has gone under. Now regulators are going to do whatever they are going to do, but is it going to have a larger impact on the US market and more specifically the Indian market? So in order to understand that how this Silicon Valley Bank crisis is going to impact the other bank, you need to again go back to the genesis of the crisis, and therefore I had explained you everything fundamentally. And this chart is fairly important. Now, if you look at the held till maturity securities for other prominent US bank, if you consider JP Morgan, Morgan Stanley, all the major banks that are there in the US, what you will notice is that there is unrealized losses on investment securities currently with these banks, and this amounts in billions of dollars. For example, right now these banks are sitting of unrealized losses of roughly $670 billion. This is a fairly large figure. But again, please go back to the section that I was explaining, that if you simply hold on to your hold till maturity securities, these unrealized losses are not going to hit your balance sheet. These are safer securities. There is no issue there. But in case of Silicon Valley Bank, they had no other option but to sell their securities. These other big banks, be it JP Morgan, Morgan Stanley, at least from the look at the data, it doesn't appear that they are facing any kind of liquidity crunch, and they don't have to book losses here. It is like me saying that you purchased Nifty 50 at 18,500 levels. Right now, the Nifty is at 17,300, 400 levels. You are sitting on a little bit of loss, but is that real loss? The answer is no, it is notional loss, and it is very, very likely that Nifty 50 is going to go back to 18,500. And here we are talking about the stock market, which is risky. But in HTM securities, these are usually safe securities, and if you hold them till maturity, then your unrealized losses will go away, because these unrealized losses are marked to market on the secondary market. So these banks do not necessarily need to sell it right now. So now you might have another natural question, कि यार in 2008 also something similar happened, that because Lehman Brothers collapsed, then other banks collapsed with it. So let me explain that point also. So in the 2008 crisis, there was something called a subprime loan. So these were packaged as investment grade instruments, and not only Lehman Brothers had access to that, but a wide range of banks had access to that. In the current situation that we are analyzing, these are hold till maturity securities. These are safe assets. Subprime loans were unsafe assets. So please understand the concept of underlying, that in 2008 crisis, the underlying was really bad to begin with. Those were subprime loans. Those were fuddu, ekdam bekar se loans. Here, the hold till maturity securities underlying structure is strong enough. It is just a credit crunch that the bank suffered. And as a result, a lot of customers ran to the bank to withdraw their money, and that led to a bank run situation. So this brings us to the third and final section as to what would be the impact on the Indian stock market and the US stock market. So let me start with the US stock market. I feel that this is a sentimental issue first and foremost. So a lot of US banks will continue to suffer for a little bit. It is not a fundamental issue. It is likely to get solved, and therefore I'll be purchasing some of the US banks also. Which ones I will let you know in the YouTube member community. But I feel that due to the knee-jerk reaction and people not understanding the basics around it, there will be a panic-like situation for the next few days. This is part A. Part B is that it is very likely that some kind of restructuring might happen in the bank itself, and the bank will be supported by regulators. Now comes the discussion on the Indian stock market. So is the Indian stock market likely to fall? Now short term, I can't predict. Most likely it is going to fall. Why? Because again, people would not understand the fundamentals. People will go by the emotional triggers that are being pulled. And this is a complex situation to understand, because कौन पढ़ेगा bond के बारे में, कौन पढ़ेगा mortgage securities के बारे में, and people just blow up the news and try to create a panic. Now comes the second part of the impact and the actual impact that might happen according to me. And this commentary comes from Gary Tan. I had shown you earlier, so I'll show it to you again. He has called it an extension level event. But extension level for whom? For the startups, for the bank, for the stock market. So you need to define that. So I feel that this is an extinction level event for some of the startups for sure. So in this Silicon Valley Bank issue, the money of the depositors, which is the startup, is going to get stuck for a little bit of time for sure. So if, let's say, for the next 6 months, till the time entire restructuring is done, the bank is recapitalized, or some solution is being built, how to return money to the depositors, the startups who are struggling financially, they will be unable to pay the salary of the employees. And what do you think is going to happen to those employees? Are they going to work for free? The answer is no, they are not going to work for free. They are most likely going to join some other company. And then there will be a host of challenges that these startups might face. So this startup funding winter is likely to continue for a lot of startups. I don't know. I haven't studied the internal balance sheet of different startups, and neither can I comment on the veracity of this. But to my understanding, when Gary Tan quoted the extinction level event scenario, it was mostly pertaining to startups, not necessarily the stock market. And going forward, I am very much hopeful, and my bullishness regarding the stock market continues to be intact. Yes, there is a very high likelihood that in the short term, the stock markets might correct and the sideways movement might continue for a few more months. But I am overall bullish, and I feel that the world is resilient enough in order to overcome these type of travesties. Thank you so much for watching. I hope you enjoyed the content. If you did, do press the like button, share it with your friends, and I will see you soon.